We're doing it this week, June 14th, because we're about to enter a really bad period for corn prices historically. This is a terrible time from June 14th to September 30th for seasonality. Corn prices go down a lot more than they go up. We're going to examine that phenomenon. And then we're going to look at the times when corn did go up, went counter trend, and look at what data might be in common and see if there's any data driven reasons this year to be optimistic. So let me start with just kind of looking at what the seasonality has been. So if you take a look, here's a graph of what corn prices have done from June 14th to September 30th. The x-axis are the different years starting in 1996 going all the way out to 2023. The y-axis is the percent change in the DEES futures price from June 14th to September 30th. First thing that would strike you is there's a lot more red lines to the downside than green lines to the upside. In fact, we've gone down 20 out of the last 28 years. That's a lot of years. 20 out of the last 28 years we've gone down. We've only gone up 8 years. The average up year, a lot of times people say, yeah, but we go up a lot more than we go down. Well, the average up year was 13.7%. Those 8 years, the average was 13.7% up. But the average down year was down 15.7%. We actually go down more than we go up in numbers and in percentages. That meant the overall average over the 28 years was 7.3%, right? So overall average was 7.3%. And when you look at those 8 years that went up, some of them barely went up. There's 3 that barely went up. Only 5 years went up more than 2%. 5 out of 28 years, last 28 years, went up more than 2%. In fact, 7 out of those 28 years went down more than 15%. So this is a really skewed period. It's a really bad period, bad season for corn prices, and it's been bad even recently. When you look at the last 10 years, we've gone down 8 of the last 10 years, and the average for those last 10 years has been down 9.6%. So it's stayed with us over these last 10 years. So it got me thinking, with the 5 years that we did really, really well, right? Where 5 years we actually went up 2% or more. That was 2002, 2010, 2012, 2015, 2020. As we sat on June 14th, was there anything that we could look at the data and get any indications or any commonality in the data that would be common between those 5 years? Is there something that gave us a tell when we look back at those 5 years and said, let's look at all the data for June 14th, for those 5 years and the other 23 years, was there something that stood out for those 5 years, right? And that's what we're going to go look at. I've got about 5 or 6 different indicators that I'm going to show you that were interesting in those 5 years. So those indicators go across price patterns, where there are price patterns leading up to June 14th or on June 14th, fundamental statistics, production, export, supply, demand type things, weather indicators, CFTC positions data, futures positions data, where specs or managed money or commercials positioned a particular way on June 14th that gave us some tell. Or is there anything else? Currency, energy prices, anything else? So with that, let's get right into it. And here's one last one. We're going to switch and talk about market structure and just positioning of traders. In this particular case, we're going to talk about what managed money is doing. So these are money managers, CTAs, commodity trading advisors, who take people's money and invest it in the futures markets to have them make money, right? To speculate on markets using futures and options and to make money. And when their positions are reported and the CFTC reports the positions, sometimes they show up as being long, sometimes they show up as being short because they're just trying to make money. And one of the things they're using are corn futures as well as soybeans and wheat and other things, right? So on average, those money managers are neutral. because sometimes they're long, sometimes they're short. What's interesting, I'm going to, just in the interest of time, I'm not going to talk about how they're positioned long or short and what that means. What's more valuable is how have they changed their position? In particular, how have they changed their position over the last 6 months ending June 14th? So we're looking at how did they change their position from mid-December to mid June. And the x axis here kind of tells you that when it gets negative, that means they got less long or they went from long to short. Okay. Or they got more short, right? If it's positive, that means they got more long, they went from short to long, or they got less short, right? Because this is the change in position. It doesn't mean that they're long or they're short. It means that they got more long or they got more short, or in some way, right, went from short to long, or they got less short. That would be to the right side on this axis. So what's happening here is, on average, as of June 14th, sometimes they went, more long, sometimes they went more short. They went, both ways. However, when you look at the 5 years that were the good years for corn going forward, managed money got either less long or more short. They did the wrong thing, in other words, right? So they took a long position and they cut it back. They took a long position and they turned it into short, or they took a short position and went more short. That's what this is saying. On average, they were minus 9.1. So they moved in the wrong direction just before the markets went up. And if you do this cluster analysis, you'll see that, when that number went -5, which means they definitely got meaningfully less long or more short, those were the years on average that we went up. We went up and down equal numbers, 10 years total, 5 up years, 5 down years, but we went up more than we went down. That's why the average is so good. But in the years that they added to their long, or they ended up cutting back on their short, so they net went long, those were the years that we actually went down. 9 years they added to their long or cut back on their short. Only one of those years was an up year. And it wasn't very much of an up year. It's this one out here. So in 8 of those years went down, and the down was about -14%. So this is kind of interesting. That move that managed money made is a wrong move. Again, it's neutral. The value is about zero right now. Managed money hasn't gotten more long or more short. So we're kind of in that middle no man's land, right? So as I look through this, we have a lot where we're just kind of in the middle with these. All right. Well, thanks with sticking with me. I know I said this might be 7 to 10 minutes, and then as I got into it, it definitely had to be a bit longer, but I hope it was interesting for you. Again, I'm Satish Nandaperker, Director of Data-Driven Strategies with Quantum Hedging. We'll be back with our normal podcast every single week. And thanks for listening. Thanks for being a subscriber.